Okay, so you've spent your whole life saving for retirement. Awesome. But now comes the really tricky part. How do you actually pay yourself? And more importantly, how do you do it without writing a giant check to the IRS every year? Well, that's what we're diving into today, building your own tax-smart retirement paycheck.
All right, let's just imagine it for a second. The day has come. You've retired. That paycheck you've gotten used to for what, 30, 40 years? Poof, it's gone. And suddenly, the big question isn't just, do I have enough money? It's, how in the world do I get this money out of my accounts and into my bank account without losing a ton of it to taxes? That's the real puzzle.
So let's talk about solving this puzzle. The key thing to get your head around is this. You're not trying to create one giant paycheck to replace your old one. Nope. It's more like piecing together a few mini paychecks from different places to get the total income you need.
Okay, so where do we even start? It's actually a really simple two-step process to figure out what we call your portfolio paycheck. First, just tally up all your fixed income. You know, the stuff that's going to hit your bank account no matter what. Social Security, maybe a pension, that kind of thing. Then, step two, figure out how much you actually want to spend in a year and subtract that fixed income from it. Whatever's left over, well, that's the gap. That's the job your portfolio has to do. Let's make this real with an example. Say your goal is to live on a nice, round $100,000 a year. And let's say your Social Security and other fixed income adds up to $45,000. You do the math, and there it is. Your portfolio needs to generate $55,000. That's our magic number. That's the target.
All right, we have our target, 55 grand. But where exactly does that money come from? To answer that, we've got to understand the tools in our toolbox. And I'm talking about your different retirement accounts, and this is the most important part, how each one gets taxed.
This is one of my favorite ways to look at it. Just picture all your retirement savings sitting in 3 different buckets. It's a simple idea, but it's absolutely critical for what we're about to do. Because the rule for one bucket is totally different from the rule for another when it comes to taxes on withdrawals.
So here they are, the big 3. First up, you've got your taxable bucket. This is like a standard brokerage account. You're paying taxes on dividends and capital gains along the way. Then there's the tax-deferred bucket. This is your classic 401k or traditional IRA. You got a nice tax break putting the money in, right? But the tax man is waiting. You'll pay income tax on every single dollar you take out. And then the golden goose, the tax-free bucket. This is your Roth IRA or Roth 401k. You paid your taxes up front, which means every penny you withdraw in retirement is yours to keep, completely tax-free.
Okay, so quick recap. We know how much money we need, and we know about our 3 buckets. Now for the fun part, the actual strategy. How do we pull money from these different buckets to pay the least amount of tax possible? Seriously, this is where it gets good.
So, you've got 2 basic ways to go here. There's the common path. This is what most people do, maybe what you've heard you're supposed to do. They spend their taxable money first, then their tax-deferred money, and they save that precious Roth money for the very end. But then, there's the tax-smart path. And this is a whole different ballgame. It's not about a simple 1, 2, 3 order. It's about being strategic and actively managing your tax bracket each and every year.
And look, the conventional wisdom makes sense on the surface, right? Let your best accounts grow for as long as you can. You hear it all the time. But the problem is, that thinking is a little too simple. It's not wrong exactly, but it's like playing checkers when you could be playing chess. It leaves a ton of money on the table in the form of tax savings.
So that leads us to the big, game-changing question. What if we just stopped focusing on the order of the accounts? What if instead we focused all our energy on our tax bracket for the year? This one little shift in thinking, it changes everything. And here is exactly why that matters so much. Take a look at these tax brackets. We're using the 2021 numbers for a married couple just as an example. You see that for income up to around $80,000, you're in the 12% bracket. But look what happens the second you make $1 more. Bam! You're paying 22% on that next chunk of income. That is a massive jump. It's like a tax cliff. And the whole goal of our strategy is to get the money we need without falling off that cliff. Okay, let's put this into practice with a real-world scenario. Let's say your Social Security and other stuff gives you $60,000 of taxable income for the year. But you've done the math, and you need another $40,000 from your portfolio to live the way you want. So how do you get that 40 grand?
All right, here's the smart play. You look at that 12% tax bracket and see it goes up to about $80,000. Since you already have $60,000 of income, you've got about $20,000 of room left in that low bracket. So what do? You pull exactly $20,000 from your tax-deferred IRA.
That withdrawal fills up the 12% bracket perfectly. But you still need another $20,000, right? No problem. You just take that from your tax-free Roth account.
And right there, that is the aha moment. Think about what just happened. You got the $40,000 you needed for the year. But because you were smart about it, blending the withdrawals from two different buckets, not a single dollar of it was taxed at that higher 22% rate. You didn't just let taxes happen, you took control. You played the game.
Now, this is brilliant for 1 year, but a truly great strategy isn't just about this year. It's about the long game. You have to think about how what you do today is going to set you up for success 5, 10, even 20 years down the road. Because you see, just managing your tax bracket year to year is only part of it. You've got to think about the other moving pieces. For instance, if you're too shy about taking money from your traditional IRA now, that account could grow into a monster. And then, when required minimum distributions, RMDs, kick in later, you could be forced to take out huge tax-heavy withdrawals you don't want. Plus, you have to think about how your income affects taxes on your Social Security or even your Medicare premiums. It's a living, breathing plan, not just a simple rule you follow blindly.
So really, it all comes down to this one question. The common way of doing things, taxable, then deferred, then Roth. It's easy. It's a habit. But as you've just seen, it can be a really expensive habit. The tax smart way, well, that's a plan. It takes a little more thought, a little more intention each year. But it is absolutely the key to making sure more of your money stays your money. So, what's your retirement income going to be based on? A plan or just a habit?